is Viant Technology. And just a quick bio on this company. These guys, and let me read it off to you, operates as an advertising technology company, provides household ID, a people-based innovation that combines digital personal identifiers into normalized household profile. AI bid optimizer solution that enables AI to analyze historic bid opportunities to predict the lowest media cost for desired advertisement. So these guys are offering a company, let's say you're Allstate Insurance, you want to sell insurance products, obviously. And as people are on Facebook and Instagram and YouTube, you'll be presented with ads if you have a propensity to, or you're a good target for insurance, or maybe you did a couple of searches for insurance. And having that type of ability to recommend the next ad to the right people is ideal for these advertisers, because then they are optimizing their advertising spend and are then able to really deliver a lot of value for their customers. I really think it's a very valuable thing. Now, the stock has done just really well, up 128%. It's had a pullback, a little one. Maybe I can go to the 6 month, and it's pulled back 10%. So it's had a nice little correction, but boy, did it climb. It climbed from the August timeframe to its peak, went up 126%. Whew. What a beautiful ride. This is a small cap too, which is interesting. Now, these guys are a lot like Applovin, and Applovin is really doing well. Applovin does the same thing. Now, Applovin is doing a little better, a lot better, actually. Now, I think Applovin is overpriced, and it's easy to make that argument because it's gone up so much. But I mean, it's really worked, right? Both stocks have really worked. Now, these here, the big question is, are these businesses, do they have a solid moat, a barrier of entry? They're using a lot of this household data, and the kings of data, right, are going to be Google Alphabet, Apple, Meta. And they have so much data. It's eye-opening. And those guys could really provide the data to their customers so that they can advertise most successfully. I would say that could be a threat, but it's not a direct threat, because the customer, right, the client, they want a third party to maybe be involved, because if they're going to be spending dollars on Facebook or Instagram, they don't want Meta to tell them, oh, this is how you should spend it. No, they want a third party with maybe a impartial recommendation to say, no, instead of advertising on Facebook, you should advertise on TikTok, or you should advertise on Snapchat, or you should advertise on over here, because the target market you're going after, you're going to be able to advertise at half the rate that you would advertise on Facebook and get twice the results. So you really want to go there instead. So maybe a third party gives you that value add, or if anything, just assures the client that you're getting that unbiased, independent recommendation. They're not driven by dollars of, of course, YouTube would tell you, hey, you should advertise a lot more on YouTube and give us more money. Instead, you go to a third party. So I would say that their moat is okay. Could it be threatened? Yes. Do these companies have value? Absolutely. Other companies that might threaten this space, maybe even acquire these companies, or companies like Salesforce, CRM, right? They're in the customer experience space, and they may say like, hey, we want to compete for this and own this part of that client ecosystem and grow Salesforce. I don't know if they'd be successful at it, because it takes some really good know-how, and obviously customers are really going towards Applovin and Viant. So let's take a look at Viant. So Viant, this is the first time I've ever seen this company today, and they are located, they're a technology company. They're located in Irvine, California. I'm standing about less than 10 miles away from this address. Oh, how interesting. Never even knew these guys existed, and here they are. So this is Viant. Okay, so they're in California. And the market cap's fairly low, 1.2 billion. Revenue is 263, 64 million. Forward P is 36. let's look at their growth. Analysts think it's a little expensive. It's really gone up a lot. So analysts might be a little behind. But here's where like both Applovin and this stock have really just taken off. What happened in the third quarter? Do you happen to know, Ed Kiter? I know this is kind of new to you too, but what happened to just make?
I don't know, and no, I don't know. I don't want to speculate, but I believe it's nothing special. It's simply the notion that AI now is the next big trend will be in the software companies after the hardware companies, and that's maybe what ignites the trend.
Mm-hmm. Okay.
I don't know if anything special.
Just maybe the market found Applovin and Viant and said, "Wow, these are really good businesses." Okay, so the company, they've been around for a little while. At least they've been publicly traded for a little while, and they've been a little bit of growing, slow down, growth, slow down, grow. And the quarterly looked pretty good, 34% growth. So there's a little bit of like seasonality. In 2022, a lot of things were coming down. I think we had a pretty good pullback on stocks. I think businesses were a little concerned, so they pulled back on spend. Okay, I understand that. 2020, we had a giant pandemic. Yeah, so businesses pulled back. Okay, these 2 years, I'm not too worried about. Okay, it's not like it's a broken business and they're trying to fix it. No, these are understandable, explainable reductions in revenue that were market driven, not company specific. So they have been growing free cash flow over time. They were, I guess 6 years ago, they were 3 billion. Now they're trailing 12 months, 55 billion. Very good. Their gross margin is 46%. Not quite like a software company, but good.
You mean million, not billion, I guess. The free cash flow.
I'm sorry if I said billion. It's million.
Yeah. Okay.
So gross margins 46%. Not great margins, but good. Yeah. Okay, it looks good there. I looked at their balance sheet. It looks good. They have more cash than debt. It's always a sign of a strong business, especially a relatively young business that has more cash than debt. It's a very good sign. They're in a business that's desirable. Businesses that generate more cash than debt over time just end up being really valuable, and especially if they're growing. So this business is growing, free cash flow. So those things obviously look good. Now the matter is it expensive or not? So let's go to evaluation. Now I had a little bit of a head start because you gave me this stock before we started the call. And assuming that they keep growing that free cash flow, and that might be, this is a smaller company, so I'm gonna go to 9% since they are a small cap. And I'm gonna tune down the growth because what if we have a down year, right? Like they showed that certain big factors in the economy could really reduce their revenue. So let me tone that down a bit. Even when I tone it down, the stock's still discounted. I did a forecast of cash over the next 4 years growing at 15% and then 5% after that. This is a really small company, so they can keep growing at a really good clip. It provides a really good value. They have more cash than debt. So the equity value is 2.1 billion. The market cap of the company is 1.2 billion. So there's like an 80% discount on cash. If they can keep producing this cash, these guys are going to be acquired. There's like, either they're going to be acquired or they're going to go from 1 billion to 5 billion very quickly in market cap. Now the earnings per share isn't supporting the stock, but that's because I'm like, I'm going with a PE of 36. If you went with a PE of 48 and they're growing much faster than 40, I'm just like, trying to be a little conservative. Like, well, what if they don't grow at 100%? Because when we looked at and that's the earnings per share, 7 analysts cover it and they think it's a little expensive. And the earnings per share, based on analyst predictions, is supposed to grow by 62%, 50%, 100%. So yeah, I would play it safe and I would leave it at like 40 or even 35. Now it's desirable business, so maybe they're like, hey, this is a really hot space. It's a place to be. It's really working for Applovin and Viant, and it looks like a good stock. Now, what's happened recently, right? We had a pullback, but all stocks are pulling back, right? We saw the pullback start in December, and stocks pulled back. Now the stock's beginning to go up again. So what I'm seeing is a really attractive business. This is an attractive stock. Of course, I would love to see the stock be discounted a little bit more, but this thing's really working. What could threaten the Viant or Applovin businesses, right? I guess a bigger player comes into the space that can do it better, or maybe it's deemed to be, hey, I can use Applovin or Viant and pay for this service, but it's not really giving me much. I get everything I need directly from Meta, Google Alphabet. Actually, I get better data from them. I get better results when I go direct with them. Well, if that's the case, then these guys are going to be deemed unnecessary, and they might have a hard time. The other thing that is reality is they're kind of in a narrow industry, micro industry. Like, this is what they do. That's all they do. If you recall, Apple changed their privacy policies. This is years ago, like 5 years ago, and Meta had a hard time with them. Every advertiser had a hard time with them. If we have some type of events like that, and all of a sudden the Applovin, and they are writing algorithms, okay? I know everybody calls everything AI now, right? Oh, we're using AI to do this and that and the other. They're writing the right algorithms, like, hey, under these conditions, what would be the ideal advertising channel? And then they have that decision made by the software. Perfect. We've called that algorithms 20 years ago. They're still algorithms today, but they're going to be branded with AI, which I think is accurate. I guess artificial intelligence, the software is making the decision. Can't argue with that. It's just not you, is the point I'm making. So this is a really good company, Nkiter. And look, it's going up in the after hours. It's just these here, right? Now, let's talk about where you enter a stock like this. I think the three of us are probably a little more value investors. And speaking for myself, I'll just speak for myself. I'm a little more of a value investor than I am kind of a growth investor. When I was a youngster and I was 25, yeah, I wanted the highest growth and the biggest bang. And, that led to some pretty good losses. And I did find a couple good, stocks. But some of the stocks just really went down fast, and I lost like 80% of my investment. I'm like, oh, I don't like doing that all that often. Now that I'm 56, and I'm like, could I see entering this stock at 19, and then it goes down to 12? Yeah, that's definitely a possibility. Could it go up to 30? Absolutely. Can it go up to 40? Yep. But I tend to play it a little bit safer, and the chart is looking like it's an expensive stock because it's kind of beginning to plateau up here, and Applovin as well. Look at this plateau. Investors are like, thinking twice about, whoa, man, the stock's really gone up. Is it going to keep going up? It could. It's just, it feels like any bit of bad news is going to drive these stocks down. I'm going to watch this stock. I'm going to watch both this one and Applovin. And we have had what I consider to be a healthy period of time over the last 30 days. We saw some of these really expensive stocks pull back a bit. Some of the stocks are like in correction territory where they lost more than 10%. All healthy stuff. Pullbacks in the right places. Technology pulled back. Consumer communication services pulled back. Consumer discretionary pulled back. And to me, that felt like, hey, you know what? That feels like the market isn't completely nuts. Like it's just going to go up forever. So that pullback was kind of good, kind of let things kind of come back down to a better valuation. If it keeps selling off, like if we had a pretty good sell-off from in the next 2 months, let's say went down another 10%, these guys in Applovin may present a really nice price. So Applovin's already one of my watch stocks, but Viant is going to be added to my watch list. So I'm glad you brought this one up. I mentioned that here's Applovin. I think it's priced a little too expensively, but man, these stocks really cranked up. So the conclusion on Viant is that it's a really desirable business that is in a very high growth space. Needless to say, advertising on all these online channels, that's what advertisers do. That's what they do now. They don't advertise in magazines or newspapers. Those days have been behind us by like 10, 20 years, and they advertise online. So good one. And those are my comments on DSP.